Welcome to Relative Return Insider, where a couple of journos and one super sharp guest take you on a deep dive into the juiciest headlines, bold opinions, and hot takes from the wealth management world. We're breaking down what's happening, why it matters, and maybe cracking a few jokes along the way.
Hello, and welcome to another episode of Relative Return Insider. My name is Maja, and joining me again in the studio, he's finally back, is my co-host Keith Ford. Welcome to the show, Keith. How are you doing, mate?
I'm doing well, thank you, Maja. Wonderful, bright sunny day. We're starting to get warm, so
spring.
Can't complain.
I think last week me and Shane spent about half an hour talking about the weather and how it applies to the economy and economics and economists. Shane, welcome back to the show. How are you?
I'm good, Maja. And yes, it is nice to see the weather. I think last week we were in the midst of another downpour in Sydney anyway. Brilliant sunshine now. Spring has definitely sprung. And welcome back, Keith.
Thank you, Shane. Thank you.
Last 2 weeks.
Yeah, we did.
Yeah, we can definitely also attest to spring being back because my wife's flowers are starting.
Oh, I thought you were going to say hay fever's back.
No.
That's a problem too.
All the flowers are starting to sprout and everything. Got some snapdragons appearing. So
Snapdragons.
all sorts.
No idea what that is. Not going to pretend. No, but that's probably the only sort of happy, positive thing that's taken place over the past week is the fact that the sun's out over Sydney. Not much else in the way of positive news, unfortunately. But I thought we could have a look at some of the sort of, hot topics in making news this week. And one of them definitely has been the major fine that ANZ Bank has copped. So basically, and I found quite interesting the press conference that ASIC, which they don't usually do these press conferences after announcing that a fine had been issued. And,
Not usually.
There
no.
were,
if you get 240 million.
Well, I was just going to say it's a lot of money, and also the bank has done some pretty poor things. And ASIC's Joe Longo.
Grubby, the word
Well,
you
I was
use?
just going to say, you're stealing words out of my mouth, Keith. Oh, he's so eager to be back on the podcast. No, but that's the word that Joe Longo used. Is he called ANZ Bank's conduct grubby? And he said that it shows systematic institutional failings, and the bank has sort of disputed him on some of these things. But Keith, do you want to tell us more? What happened at ANZ? What did they do? It does concern government bonds, and that's sort of why we're looking at it as well.
Yeah, I mean, it's obviously a massive fine. Biggest one they've ever had, right? It's the largest fine for ASIC, which it is just so much. So the vast majority, or just I think 125 million of it, is to do with the government's debt agency. So that's kind of interesting that the way they've apportioned it there. And then there's also that it had inflated the amount of government bonds that it was trading in the I think tens of billions of dollars. And then it just took months and years before anything was rectified in terms of the misreporting, which is obviously not good. And then, Longo was pretty strong calling it grubby and things along those lines. And any attempts from ANZ to kind of try and downplay the seriousness. Obviously, they were saying it was all unintentional. They weren't doing this on purpose. I have no idea if that is true or not. I don't think I have the expertise to make a call on that. But that ANZ felt that they were not doing it on purpose. It was all unintentional. But if you're misrepresenting things in the tens of billions of dollars, in accidental or not, there's clearly some issues going on. So massive fine there from ASIC and. I'd love to be able to be in a position where I could pay a $240 million fine. It seems like you'd have to be in a pretty good position to begin with to be able to withstand that kind of a hit. But it's a lot of money, and wouldn't like to be ANZ, but
no,
I'd like to have the capacity to pay a $240 million fine.
Yeah.
And it comes just a week or so after they announced those massive, cuts.
Maybe that's how they can afford it.
Maybe that's how they're going to afford a bit of black humour there. But yeah, Shane, what are your thoughts on this? It's quite a big one for ASIC and lots of money. Well, because this money, this will end up in ASIC's pockets, right?
I don't think ASIC's pockets, but it would go to government consolidated revenue, I believe.
Yeah.
I think that's how that works.
Yeah, I think it's a sign of the times that post the Royal Commission, the financial regulators have become a lot more aggressive. Mm-hmm. And, every so often, it's a different organisation gets its time in the sun, so to speak, in a negative way here, and that's what's happening. I guess the government could claim, and that's probably what has been claimed in this case, that it could have a distortionary impact on the Australian government bond market at the time. And so they're trying to guard against that. I guess some might say, well, $240 million, it's a lot of money. I have no way of weighing it up relative to the damage caused. But some might say, well, banks make record profits. In billions of dollars. So in the great scheme of things, it's not disastrous for ANZ, and they'll get over it. Obviously, they've got to change their ways, but there has been a big management turnaround at ANZ, which may partly reflect these sorts of issues, but of course in other ways not necessarily. But yes, as Keith said, it does come at a bad time for the bank because of the layoffs. They announced the layoffs. Layoffs always create a lot of angst amongst the workers at ANZ. I wouldn't want to be an ANZ worker at present. I guess many of us have gone through this in the past. And it can be really tough when these sorts of things are happening. Most of the people at ANZ are doing the right thing, and to find that they may lose their job. I think if you look at the 3,500 staff employees as 1,000 contract workers, it's about 15 to 18% on my rough calculations of the Australian workforce at ANZ being affected. So that's quite a high number. It's not like the 40 or whatever it is that CBA were talking about a few months ago. So it's a bit of a tough time for ANZ, and of course having the two things come at once is not good not good publicity for them. But obviously, bank is changing, and you could argue, well, they haven't been relative to CBA, which has shot the lights out over many years. This could set off a process for shareholders that results in even better outcomes for ANZ ultimately. But obviously, there's a work-through process before you get to that point.
Definitely. And do you think this sort of suggests that the big banks in particular are sort of struggling to implement some of those lessons from the Royal Commission?
I would have said no. This one's a little bit different, but I think most of the lessons have been learned quite well. Don't forget the Royal Commission came at the tail end of a period of tightening of macro-prudential controls. So APRA and ASIC were already out there starting in 2014 and then ramped up in 2017. And then that sort of culminated in the Royal Commission, which led to, I think, more restrictive lending practices for individuals getting a mortgage. And that is still in place. That hasn't really changed. This arguably was in a slightly different area to the things the Royal Commission focused on. You can argue that.
True.
But I wouldn't say that the banks have forgotten the lessons of the Royal Commission. History tells us, though, that as time goes by, new generation of people will come along, and yes, a lot of those lessons will be forgotten again. You can see waves of regulation and deregulation and then re-regulation in the US and Australia. America's currently going through a period of deregulation under Trump. You could argue maybe that sets us up for another period of banking misconduct or lax lending standards at some point down the track in the US. And if history is any guide, then sometimes that flows back to Australia. But there's a long way for all these sort of things to work their way through the system. But a lesson of history is that we often don't learn much from history, and the same mistakes get made, a generation later. as the Royal Commission becomes ancient history.
Yeah, 100%. And you mentioned there, is it 240 million? I've already 240 million.
Yeah.
That's a drop in the ocean compared to what Trump is asking the New York Times to cough up if he wins his defamation.
15 billion US,
billion
I think it is.
US
dollars. Like 22.5 billion Australian.
Yeah.
That'd be
that's a different topic, but just thought,
the numbers there are astronomical, and he has already won some cases. The one against was it Paramount or CBS with the 60 Minutes program?
Yeah,
and that's starting to have an impact in a negative way because it makes media companies more cautious in what they do. I mean, they removed Stephen Colbert in the midst of all of that because you could argue, well, Paramount wanted to merge with Sky. Is it Skydance? I think it was.
Skydance,
You could argue this is sort of a little bit of a grubby intervention.
Yeah, a little get rid of Colbert if you want the deal to go through type deal. That's a lot of the speculation was around that. You do worry about that. At least Jimmy Kimmel's still there. I can watch Jimmy, although he disappeared for a couple of months over the US summer. But he's back now. It's unacceptable of him. Unacceptable.
It's unacceptable.
Can't take a break.
No.
Apparently Jimmy Kimmel was doing, maybe it's this month, maybe I've missed it. You could book to see Jimmy Kimmel in New York City.
Oh,
and he was going to have Stephen Colbert on the program. Because don't forget, Stephen Colbert is based in New York and Jimmy was in LA with ABC. Right, so different audience. But Jimmy often has a lot of fun with Trump because Trump's claiming things about LA that, you go outside the studio and you can't see any signs of the things that Trump's talking about. Yeah. He writes in the streets and so on.
100%. And speaking, while we're on Trump at the moment, I think Trump sort of announced something on his favourite social media platform, Truth Social, saying that he wants corporates to move to biannual reporting. He basically argued that quarterly reporting encourages sort of short-term thinking, excessive focus on market reactions, and that eventually it can harm long-term business planning. This is probably one that you agree with him on. Although do you have that Truth social media post? Oh, we need to find it. We need to find that post because it does make reference to China. Where
it does.
It's an interesting line. But anyway, while you look for that, Shane, tell us, what do you think about this? Is he right on this one?
I think he's right. And he was right in 2018. I think some business people suggested it to him back in 2018 and he referred it to the SEC. But it didn't go anywhere. And so he's obviously just bringing it up. But he has a valid point there. If you're releasing these numbers on a quarterly basis, they do encourage short-termism because you want to make your numbers look as good as possible. So I think there's a lot of sense in that. I mean, I don't agree with lots of things Trump comes up with. But this one, I think he's on the right track. We have 6 monthly reporting in Australia. I know the banks put out some reports quarterly, but we have 6 monthly reporting in Australia, and it doesn't make our market any less efficient. There's still a short-termism there. There's always going to be a short-termism there. It's part of the way the world's gone now. But I think having this quarterly reporting is over the top. Maybe it's me. I just don't want to look at the quarterly numbers. It's such regular. It gets tedious looking at these numbers all the time. But I think it does make sense. I mean, while you're on it, you could argue, well, some of the economic stats, which have become more and more short-term, should go back to quarterly or because, in Australia, we now get the monthly CPI. It will become the de facto CPI, I think, next year, is it? And the quarterly will ultimately be replaced by the monthly once the monthly gets full coverage. But I do worry that having all this more frequent data, in some ways it's good. The RBA would say it's good, and most economists say it's good. But I do wonder whether it actually just results in a lot of noise, and the same could apply for corporate reporting. That the more frequent you get the data, the more noise that gets injected into it, and then ultimately you're better off looking at the trend. Which, mind you, 20 years ago, the RBA was trying to encourage us to do, but they are now seem to be going the other way and releasing more and more short-term data. Yeah,
definitely. But does it in any way sort of impact market transparency and then, investor decision-making if you've got these reports less, often?
That will be the main argument against it, that it may reduce transparency. that a quarterly update is a good thing. It's not stopping the long-term outperformance of the US share market, which has been in place for the last, decade now or so. US innovation has continued to pace. And Trump himself is doing lots of things, I think, to work against innovation in the US with his interventions in the US economy and in US businesses. But so in the great scheme of things, I don't think it's going to make a huge difference. But if you're going to have a choice between doing it and not doing it, I'd probably say, yes, it is better to move to 6 monthly.
Yeah. And what about sort of, with institutional investors like our super funds? Obviously, they invest heavily in the US. They sort of, one would, can argue, rely on timely corporate sort of financial data to assess portfolio holdings. What about them? Or is that not, as you mentioned, it's, it's moving from 3 to 6 months. It's not that much of a difference?
Yeah, they may say that. And most investors, like most economists, most fund managers, prefer more information than less. I'm just a bit weird in that sense. I think at some degree extra information can just result in confusion. But they may argue that. I don't think it will be a consideration for the SEC. This time around, there are greater odds of a change because more of the commissioners on the SEC have been appointed by Trump.
Yeah, of course.
And we're also seeing a situation now where most of the people that Trump's appointed are more enablers of his policies rather than people who you'd regard as adults in the room. So there may not be as much pushback from the SEC, if indeed there was last time, because he's got a different team of people there. And so it may stand a greater chance of happening this time around. I mean, a lot of investors would probably be not that happy with it because they like the updates, so to speak. And I mean, I must admit, I do in some ways like tracking it. And I'd have to change my spreadsheet now if we go to quarterly. But I think the economist in me that says, well, short-termism is a bad thing would probably say, well, okay, on balance, I'd agree with it.
Yeah, definitely.
I did find the
you?
post.
Yes,
yeah.
Please read it out.
So the China part that you were referencing is, did you ever hear the statement that China has a 50 to 100 year view on management of a company, whereas we run our companies on a quarterly basis? Then not
it's a bit
good.
Misleading.
Multiple exclamation points.
It makes it sound like it makes it sound like China, only requires its companies to report every 50 to 100 years.
I don't have a clue what Chinese reporting requirements are, so I can't say it doesn't.
That is not the case. Tell us, Shane, you would know.
I don't think it is quarterly in China. It might be 6 monthly.
Yeah, probably 6 monthly, but not every 50 years.
Trump exaggerates everything.
Yeah.
And that's the problem. And then once a lie gets made, like Gavin Newsom refused to get water from Northern California or something, it gets in the bushfires there, in the wildfires there, it gets repeated over and over. And then after a while, people start to believe it.
It becomes true.
It becomes true. But I think he's exaggerated here. But that said, China does have more of a long-term focus, and I think Chinese companies do as well. Whereas in the West, we've got more of a short-term focus. But I think it's culturally embedded in us, the way the media's gone, social media in particular. Social media has dramatically intensified the short-term focus relative to what was the case before. And I remember this debate. It was in the business world and the investment world when I started my career in the mid-'80s or the early 80s. There was a debate about whether there's too much short-termism now. So it's been around for a long time. But I think you'd struggle to argue that it stopped US companies from innovation. I mean, the argument is something along the lines that, if there's a short-term focus, then you're not going to bother innovating because you won't get the benefit for 20 years or something. I don't think there's a lot of evidence of that in relation to the US. And the US is also great at running startups, and startups are very long-term focused. Right. America has a great pool of startup capital out there, high net worth individuals that are prepared to put their money down and wait 10 years for a payoff.
Fun fact, by the way, Chinese companies report quarterly.
I
quarterly.
I also looked it up and found the same thing. Yeah, if you're on the Shanghai Stock Exchange, you do have to do the quarter.
Quarterly reporting.
Yeah.
So,
quarterly reporting.
That's how well-informed Trump is.
Oh, God. Oh, God, he's
even when the overarching point of we need less short-termism is correct. The way it's gone about is still somehow wrong. Which is surprising.
You might also look into, if you've got it in front of you there, because I'm on my device and I don't want to override it, but we might drop out of this line if I do that. You might also see how long the US has had to report quarterly. I suspect that it's been around for a long time.
Let's see. Probably forever, right? So that's my assumption.
I suspect it's a very long time.
So the Securities Exchange Act of 1934 established the SEC and the framework for disclosure by public companies, but initially focused mainly on annual reporting and material event disclosures. Quarterly reporting was introduced by the SEC in 1970.
1970?
Yeah.
Okay, so it's a long time.
55 years. Yeah, very long time. What does this mean in terms of, does it sort of how, I guess most companies would welcome it, but in terms of the way they are structured, what sort of changes would this mean they need to implement in order to say, move to buy?
Well, some companies would welcome it because
probably.
That they can focus on other things. Obviously it would be bad news for accountants and the finance department and companies because they'd have less work. It's putting the report together. It's not to collect all the data. It's just that you don't have to produce the report. Yeah. You're going from a 3-month cycle to 6-month cycle. That's the main change. But most companies would see that as a cost saving.
Yeah. It would definitely be less. I mean, it's two fewer reports a year.
Yeah.
It's definitely going to be easier for you. But I'm a long-term, advocate of anything that reduces short-term thinking. So I can't really be against this.
But it's interesting nonetheless.
There'd still be, you'd still have the disclosure rule if there's any material impact on a share. You'd still have all those disclosure rules. So I don't know. It would only really be the actual numbers per se that would be impacted more than if there's some material reason that you may not want to be invested in a company, you would still be finding out as they're doing their mandatory disclosure. It would just be those quarterly reports you wouldn't be seeing. It seems like it would be a positive move to me, but
definitely. So moving on, markets at record highs, Shane. What is going on? We were saying prior to this podcast, the economy or, the global sort of political situation has possibly, I won't say never, because I'm sure there were periods there that it was, but it's quite volatile. It's there's a lot going on. Economies as well, sort of all over the place. Does this sort of suggest that global stock markets are well and truly disconnected from the real economy?
From reality? Well, it's a reasonable question. It's funny. I had a note I put out yesterday on gold, and then there's a debate about what is the bubble that's been in place. We know what was the bubble of the 1980s. It was Japanese shares. Then in the 90s we had several Asian shares, and then the tech boom, and then we had the GFC in the 2000s, which was housing and credit related. Since then, it's become a little bit less clear what is the bubble, because if you argue, well, a lot of the gains in the US share market have been driven by tech stocks. A decade ago, we were talking about FANG, and it certainly looked bubbly and people got very worried about it, but it never really unwound. You had several corrections there with the broader US share market, but no real crash. Now it's morphed into the Magnificent Seven, and obviously there's an overlap between the FANG stocks and the Magnificent Seven. I think you take out Netflix and you add in NVIDIA. So there's still an N in there.
Yeah, don't even have to change the acronym.
Yeah, but you got to change the acronym, and some of them change their names. But the complication I find is that these stocks are producing spectacular earnings and spectacular earnings growth. So that complicates it as to whether it's really a bubble or not. But anyway, if you are a value-based investor, you would say that the markets have run too far, too fast. The forward P on US shares is around 26 times and rising seemingly every day or every second day. And then in Australian shares, it's around 21 times. We've come off a little bit in the last couple of weeks, but not much. So that I often think valuation is a useful guide because it tells us how much fuel's in the tank, what is the potential medium, longer term returns. And it's obviously more constrained with PEs at these sort of high levels. But trying to use that and then say, well, it's due for a pullback or a crash, then gets really hard. And people have been trying to make that call for the last, I don't know, quite a long time now, and it hasn't really happened. And the complication, of course, in the US is the Fed is sort of moving towards or moving back into an easing cycle. It started easing last year, cut by 100 basis points over a few months, and then paused this year with the tariffs, but now it's starting again. That could be seen as a positive for share markets, and that's what's inspired markets recently. Obviously, there'll be gyrations around the Fed meeting, as there often is. A month ago, what was driving the market was stronger earnings growth in the US, and now it's moved onto the Fed. Yeah. But that vulnerability is there. Then you've got the geopolitical risks, which are still there. Tensions with China are still there. I know China and the US are having trade talks the last few days. I don't know whether they made a lot of progress, but really difficult dilemma for Trump here, because he said that if Putin doesn't play ball in terms of trying to arrange a ceasefire in Ukraine, then he will respond with secondary tariffs on countries that buy Russian oil, namely India and China. So far, Putin hasn't played ball and Trump hasn't done anything. So either he ends up with egg on his face and doesn't respond, but if he does respond and puts more tariffs on China, then you can say goodbye to a China trade deal, which may be bad news coming into the midterm elections at the end of next year, because it would mean higher tariffs on China, more bad news for US consumers potentially. So there's issues around that. And I guess, there's bigger picture issues around the independence of the Fed. There's lots of detail around the governors still floating around, but that could have impacts over the longer term in relation to the US share market. But so I find it a difficult call. There's a whole bunch of things out there which could cause a correction in markets, and markets are somewhat stretched in terms of valuation, so the risk is high, but trying to say that with confidence that's going to happen is difficult. Other things I didn't mention there, you've got potential risk or high risk of a US government shutdown later this month. They increase the debt ceiling, but the budget still needs to be passed to fund the government. Secondly, there's rising concerns about public debt again, which could impact bond yields. So far, markets seem to be looking through it, including in France, despite the rating downgrade for France from, was it AA minus to A plus by Fitch. But obviously that is another potential concern there. But if I just take a 6 to 12 month view, you could say, well, if the Fed is now starting to ease again, other central banks are still on track. The cuts, Canada, I think there's still one more cut in Europe, despite what the ECB said when they were on hold the other week. And we've got more rate cuts in Australia, gradual rate cuts here. So those things are normally positive unless you've got a recession. And so far, it's a bit hard to argue the US is falling into recession. You've got softer jobs data, but look at the retail sales numbers. They look pretty good.
That's true. That's very true. But speaking of the US again, the other thing that's just making news this morning, have you seen our ABC reporter or the editor of ABC Americas have a showdown with Trump today? And no? Oh, well.
What's it about?
Well, basically, the journo asked, as Trump was sort of making his way to his helicopter, he's, setting off to the UK for his trip. The journo asked if it was appropriate for the president to maintain significant commercial interests while president. And Trump's answer is, in my opinion, you are hurting Australia very much right now. And they want to get along with me. Your leader is coming over to see me very soon. I'm going to tell him about you. You set a very bad tone. Is that even worth a comment?
The White House on Twitter or X or whatever, it also called him a rude foreign fake news loser.
Oh, wow. And that's our public broadcaster.
Yes, it is. So,
and who was the reporter?
His name is John Lyons. He's the editor of ABC's Americas. Yeah.
Yes.
Wow. Yeah. I mean, that's the sort of Trump thing Trump says. So it is par for the course.
Yeah. Dictator much? What do we think?
Responding to it, Lyons actually had said that when he asked the question, he quite liked the start of the question because he said, "You're probably the wealthiest person ever to occupy this White House," and he liked that part of the question, but then not so much when asking how much the wealth has increased while in office. Probably
the fact that
not.
he, poor John. The fact that the future of Australia's relationship with the US now hinges on, it's all on John's back.
Well, it is. If that was in Australia, the Australian Prime Minister was setting up a meme coin, was a phone business.
You get raked over the coals if you've got a couple of property investments in Australia. So,
that is generally
if we had Albo coin, I think you'd be in trouble. Yeah, I don't think people would like it.
Unless you are in a dictatorship or a different sort of regime. How is Trump getting away with all of this? How is
that's the thing. I often wonder how he gets away with it all.
Even just speaking to
and the
reporters
business that his sons are doing, the deal in Vietnam, the golf course or whatever it was. These things, you'd think in times past would have created a lot of controversy. And it does sort of debase the role, the stature, I think, of the White House to some degree.
It does.
Yeah.
And just America in general. Do you think we're going to have a situation like we did with, or we're having at the moment with Boris Johnson? Come sort of in 10 or so years' time, will we finally look into Trump and perhaps the deals that him or his family did while in power?
It's quite possible.
They both got the interesting hair. So
the interesting hair.
That's one of the
that's their only
one of the connections between the two.
Anyway, moving on. So we're going to deep dive into a couple of topics now. Shane, we got a bit of a tip off from an anonymous reader telling us that essentially this person's saying that credit rating agencies, so the S&Ps, the Finches of the world, that they're having an increasingly harder time to substantiate sovereign and corporate credit ratings, under which this person says is a new coercive, unpredictable tariff environment. So essentially, sort of in translation, what they're saying is, the traditional role of these rating agencies to sort of assess the credit worthiness of sovereigns and corporates is under pressure by the current sort of economic environment globally, which are mostly sort of induced by the tariffs or, the trade tensions, the protectionist policies that we're sort of seeing under Trump. What are your thoughts about this? Is there any merit to what this person is saying? This person could potentially be employed by one of the credit agencies, as far as we know.
It could be inside someone leaking or something. I'm a little bit sceptical. You could argue, well, the credit ratings agencies didn't provide a lot of warning regarding the GFC and the issues around the high yield funds and was it subprime and so on all those years ago. The other aspect is you could argue the tariffs are just another sort of economic. There's always things out there creating uncertainty in terms of the economic environment and the blowback of whatever those things are on public debt or even corporate debt. And credit ratings agencies always have to deal with them. And I mean, the tariffs are big, but I think over the years, there's been lots of other things that have also intervened and created lots of uncertainty. So I don't know that the environment is radically different for the ratings agencies. I do wonder sometimes whether, we go through things and we think they're bigger than ever before and it's worse than ever before. And
then something worse comes along.
And then something else comes along and think, oh, geez, that's worse. Like I thought the LTCM crisis and talk of Armageddon in 1998 was the biggest ever. And then we go on for another thing. But and it was similar to your comment, what you raised last week with BlackRock saying it's hard to find good diversified assets these days, good diversifiers these days. And I later thought I didn't really answer the question on that one either. But I don't think anything's really changed in the great scheme of things. I think the world's always been a little bit unpredictable. Sometimes it's more unpredictable than it used to be. It's always hard to find perfectly good diversifiers. I think of the 1970s. where if you're thinking, well, I better buy government bonds as protection if share markets come down, and then the share markets collapse and government bonds collapse at the same time, because the problem driving both was the same. It was high inflation. So we saw that same thing in 2022, 3 years ago, that you go through these periods where you've got common drivers of all your assets, and then the only diversifier is really cash. And so I think there's a tendency to sort of go through periods and think, oh, this is bigger than what we've seen for the last 5 years or the last 10 years, but not see it in a truly historical context. And then when you see it in a truly historical context, you'd say, well, the ratings agencies should still be able to do their job, despite what's going on. And we always have a problem trying to find good diversifiers, because nothing is a perfect diversifier. Maybe cash is. It's always there, and you've got in a good, secure location. But so yeah, I'm a little bit. I wouldn't read too much into that. I wouldn't be that worried about it. I think there's always issues with ratings agencies, and I don't really think the tariffs change things that much for them.
But do you think that sort of their rating models, perhaps, I don't know what I assume, I think it's sort of historical financial data, debt levels, cash flow, that sort of thing.
Well, those things are still valid. They'd still be looking at those things.
Macroeconomic trends.
You'd still be looking at those things. And then you'd say, well, tariffs are another uncertainty. A few years ago, you might have said it was something else. The war in Ukraine, or whatever's going on in the Middle East is a new uncertainty. There's always something, or climate change. Someone will come out now, given that report that came out earlier this week in Australia. Someone will say, "Oh, well, that's a new uncertainty, bigger than ever, bigger than Ben-Hur, total disaster." Maybe that's going to make things really difficult. And I'm kind of thinking, well, I've heard all these things before, that, that this is going to cause a major change. That's going to cause a major change, and ultimately, history continues to rhyme. It doesn't repeat, as Mark Twain was once said. It doesn't repeat precisely, but it does rhyme. You get the same cycles out there. You get noisy events intervene and confuse things. We go from periods of war to periods of peace and so on. So I don't really think that what we're seeing is enough to change their fundamental models. You'd still be looking at whether, in the case of, say, France, you'd still be looking at issues around debt sustainability. I reckon the real difficulty they face is that there's so much demand for public debt by institutions that I did see this one paper released at the Jackson Hole Symposium by the Fed recently, which was something along the lines, the Fed could keep issuing public debt and it could go as high as 200%, 250% of US GDP. It's currently about 125% of US GDP. It could go as high as 250% of GDP, and they'd still face the same bond yield. Nothing would change. And of course, the ratings agencies right through that would be downgrading the rating. But we've seen with Japan, if Japan borrows from itself and the US borrows in US dollars, it's quite conceivable that a country could go on ramping up this debt for a while and no problem ensues. And therefore, the ratings agencies could be then accused of playing chicken little by downgrading them. True. But then ultimately, there is a risk there. At some point, you just don't know when it's going to impact, and that's the problem. But the fundamental reality is that this constant institutional demand for what is perceived as an asset where ultimately you will get paid back, that acts as a steadying hand. And it's the same with Japanese bonds. It's probably the same to some degree with US bonds. Although I don't want to push that too far. It's just a cautionary tale about getting too negative about public debt.
Yeah, and I wanted to ask you though. So we've seen this is sort of a more granular level, but the sort of credit rating, and what are they called? Zenith and S&P, Lonsec. What are they called? What do we refer to?
They're research
agencies. Yeah. That's the word I'm looking for. So Metrics, the biggest sort of private credit provider in Australia, last week Lonsec announced that it was downgrading sort of several of their funds based on sort of governance concerns, as they said. Yeah. And then yesterday we sort of had reports of Zenith coming out and saying that they uphold their very sort of high ratings of of metrics that they see no governance concerns. And in fact, they, commended the CEO and the management team at Metrics for doing just a wonderful job. So there you have these two agencies that are sort of, or research houses that are diverging in the way they rate these funds. Is that applicable to this conversation as well? And then how do you who do you trust? Who do you trust? How does this sort of work? I thought they both operated on some sort of core principles of, ratings principles. I don't know. But
if you're on the fence, you probably want them to both. You just go for only things that both agree on, or something. If you're on the fence,
now they're diverging. So one's saying there's governance concerns, the other's saying no, governance is just flourishing. It's all wonderful, all rosy and. Yeah. What are your thoughts?
I think I answered the ratings agency question in relation to the Fitches and S&Ps and Moody's of the world.
That was that question. But I'm drawing a parallel.
You do have sometimes divergence between them. But the way I would look at it is as Keith just said, you'd probably look at, you've got three main ones and maybe look at the two and take an average of them. And I think it would be the same in relation to this, that there's things where they use quantitative data and they probably agree, and the staff between these research houses often rotate. You might leave Zenith and you go to someone else.
Yeah.
True. But probably don't want me to say this, but that's the reality. So you pop up somewhere else. And so they would have common approaches. But then you've got other areas where there's a qualitative assessment, and obviously someone has made that qualitative assessment in terms of governance, and maybe that's where there's scope for some disagreements between them. But still, I'd sort of agree with where Keith's at, that if someone's raising it, flagging it as an issue, it would give you a bit of caution over it. Even if the other one's saying there's nothing wrong with it, you'd probably go somewhere in between. And I think if you're an investor, like if you're a fund manager, another fund manager, say, or an aggregator like a superannuation fund, you'd probably want to delve into it a bit more to see
you would.
What the difference is. For an individual investor, that might be a little bit harder, but I think an individual investor would still be right to be a little bit cautious. If one research house is raising those sorts of questions, you sort of want to look at it a little bit more.
If you've got like a history of working with metrics, or any company that has some kind of ratings downgrade from one agency and the other one sticks with them and they're fine with it, then you may you'd probably look at it as, all right, I haven't seen anything. I've been an investor that's been involved with this company for a while. I'm not really seeing what the rating agency's downgrading. The other one's fine. That might lean you to stick with them, that kind of thing.
Yeah, that's true.
It probably more of an impact on those investors that are kind of moving to a company or a fund or anything along those lines, if the rating at one is a little bit lower. Now, it has moved. It's not like it's been downgraded to, you should be selling off if you hold anything or anything like that.
It's from recommended to sort of watch.
Okay, right.
Something along those lines. So it's a bit of a,
But then does the idea of, when you're looking at, how these research houses have done their ratings and things like that, do you then look at, are there any potential biases from these agencies with these companies, or how can you ensure that there's nothing kind of clouding what they're doing?
Yeah, good question.
Well, that is a good question.
We're all humans.
We're in a funny position because we have funds that get rated by ratings agencies, research houses, and we also run multi-manager funds. And so we would rely on, in some cases, consultants. They often used to be called consultants at the institutional level, like the Mercers and the Watson Willett, or whatever they're called these days, that they would be called consultants. And so, we're on both sides of it. And generally speaking, I think those who are on the side where we're actually picking managers would say, well, we take what the ratings agency says or what their advice might be, but we also do our own work on it. So that's why we've got a bit of a way to look into it. But I must admit, it is difficult for individual investors, even for financial planners. You just got to take. It is. In many cases, they've only got enough money to subscribe to one research house. And so they just have to take that as it is. But it's probably better than I think that's a lot better than doing nothing. But it does create these difficult patches. I guess you could argue, well, if there's a sort of a question mark over something, then you'd probably want to look more closely at it. That'd be the way I would see it. But there's no easy answer in all of this.
Which, for instance, if you're subscribed to Zenith and you're not subscribed to Lonsec as, an advisor or something like that, if you're only subscribed to one, you may be able to see that there's been a change in the rating from Lonsec, but you aren't necessarily able to see what the rationale is in depth because you can't access the report.
Yeah, that's right.
Whereas then you can see the Zenith report and you can see what they've said. Not being able to compare them, I guess, would put you in a tough position where you might be like, damn it, I've got to pay for a second rating agency.
So we understand as well that speaking of ratings in this space, we've sort of moved on from the credit sovereign ratings onto these agencies. But ASIC, as you know, Shane, and most of our audience does as well, they're sort of looking at capital markets and in particular sort of that private credit space. And they're calling it opaque. They have a few issues in terms of transparency and governance in that space. And one of the things they're actually looking at, it's our understanding, is also these inconsistencies in ratings. Because from what ASIC it seems like ASIC has found, is that they don't, and we see it plainly here, they don't sort of agree on sort of standard things. They do diverge quite a bit, like in this case where one's saying governance great, thumbs up, and the other's saying governance terrible, thumbs down. And that is an issue for the regulators as well as, how
this
can
is
that be the case?
This is the research houses rating the private debt funds.
Yes, yeah.
Where ASIC is seeing a divergence in assessments. Yeah, it's a difficult one.
Yeah.
It's a bit like, in my profession as an economist, or focusing on the investment world, there's often differences of opinion there. So you can sort of understand where that might arise from. Some will give more weight to valuations and things, and others will give more weight to growth potential. So there's, in some ways you could argue, well, it's healthy that you've got these organisations out there and sometimes they have differences of opinion. If they all had the same opinion, then you might worry that they're not competing. They're
not doing the work independently.
They're not doing the work independently, just following each other, just herding. It's like, Reserve Bank board, they wanted to have more experts on the monetary setting board, and part of the argument was so they could challenge the Reserve Bank, which obviously implies there can be differences of opinion about these things. And I think the same would go for private debt funds or any fund, for example, out there, it could be differences of opinion. So I can see where ASIC is coming from, but then by the same token, if they were all coming up with the same opinion, then I'd be a bit worried about that as well. And I think that differences of opinion may also arise because the private debt space as an investment option, private debt historically has been around for a long time, but it was harder to get into it. But as an investment option that's available almost mainstream now, it's still relatively new.
Yeah.
And therefore you might have more divergences of opinion simply because the research houses are still struggling to get fully on top of it. You could argue, well, we haven't been through a full cycle yet. And that may lead to, people therefore have to make different judgments about how a private debt team will handle that in the absence of that knowledge.
Yeah. And then it comes down to how each rating agency interprets any specific things. Like I believe, one of the concerns from Lonsec's side in this instance was around like related party transactions, and Zenith kind of didn't really raise any issues in that regard. And so it could just be how much weight each rating agency or research agency, places on specific metrics for how they judge a fund or anything like that, which then becomes, unless you know what the methodology is that each use, then it becomes and the whole point of these research houses is so that you don't have to go into that much detail yourself.
That's right. That's right.
So yeah, you don't want to be doing your own research rating for the research house.
Yeah.
To be knowing which one you want to trust.
Well, you probably have to.
Yeah,
to be fair, you probably have to.
Everyone's got their own due diligence that they have to do at the end of the day, whether you're an institutional investor, an individual investor, a financial advisor, anyone in that chain, you should be doing your own due diligence to some degree. Yeah. You should hopefully be able to trust the rating agencies are doing theirs correctly. But whether or not that's correct, who knows?
Yeah, a competitor of ours going to the GFC was Basis Capital. If you have long memories,
not long enough apparently.
Not long enough.
You Googled Basis Capital. I think was the Australian fund, yield fund.
Mm-hmm.
Anyway, it was made Fund Manager of the Year or Yield Manager of the Year. I think it won the award in 2007, and then in 2008 it was the one that lost a lot of its money. So it had bets on subprime, and it was a research house that rated it or gave it that award for Yield Manager of the Year in 2007. I think it was 2007.
That's interesting.
Yeah.
So there is a history of ratings agencies. Like everybody can miss things and get things wrong. I think that episode led to a huge rethink of the way ratings agencies or research houses do their work. So it's something you need to be, investors, financial planners need to be aware of, that no one's infallible in all of this.
Yeah.
And ultimately, it's an argument to be skeptical of things like financial engineering, to realize there's no free lunch, make sure you've got a good amount of diversification in your portfolio.
Yeah.
Past performance is not necessarily a guarantee of future performance, and so on.
Yeah, and you also then are you're relying on every step in the chain doing their job correctly. Like the research houses, to a degree, are relying on the auditors doing their job correctly, so that when they're reading the audit reports, they're
that is
placing
an issue in private credit, the valuations aspect.
All of the valuations, every step in the chain. So you need to be ensuring that the auditor's doing their job, then you need the research house, then you need the investment advisor, or, all the way through everyone. Yeah. And then if there's some link that hasn't done it correctly, it could just be that one that causes the issue. And that's not a good place to be.
But moving on, because we've run out of time, and I do want to cover this last one with you, Shane. So there's been reports sort of circulating in the media that there's a possibility, or ASX and ASIC are looking into the possibility of allowing a company called Rocked to sort of become the first to have an initial public offering across both the ASX and the NASDAQ. So basically, this could be the first time, as I mentioned, that a company lists or does an IPO, performs an IPO at the exact same time across two different stock exchanges that are, separated by a long distance. What do you think about this? Obviously, we've been looking at the government, the regulators have been looking at ways to help the ASX grow. There's been a sort of what would you call it? Oh my God, I can't think of the word. There's been a downward trend. There's been a downward trend in the number of IPOs on the ASX over the past few years, and ASIC in particular has been looking at whether the ASX has become less attractive, whether it's too costly for companies to list, sort of what's going on. And this seems to be perhaps an answer they're exploring as part of a sort of broader initiative to make the ASX a bit more attractive. What are your thoughts about this one? How does this work? Can this work? What are the issues?
Well, conceivably it can work. I think it's probably a good idea because it does expand dramatically the investor base across the two exchanges. Obviously, the US is a much bigger market in terms of investors, so that's good news. We do have dual listings and have for many, many years. And so I think this would just be a natural extension of that. And I guess the stock would remain listed on both exchanges. So I actually think it's a good move. I don't see anything wrong with it. It's an Australian company, as far as I understand. It's an Australian company. Presumably, it must have some interest in the US.
I think it moved
business.
its headquarters to New York in
Yeah.
recent years. I'm not sure when exactly, but there was something along those lines.
So there is an argument, therefore, that it's sort of got a foot in both countries and therefore you can justify having that listing from get-go in both countries rather than listing in one and then seeking a dual listing later. So I think it makes sense. I don't see any major problems with it. We just have to see how it would go, whether it actually works.
That's the thing, yeah. And how would you for the company itself being sort of technically, exposed to two stock exchanges, having its shares trade on two? How does that sort of how does that work? How does that gel together?
Well, they trades on both countries, and people arbitrage in between. If the price gets out of whack in one country versus another, then investors can arbitrage one. And we've had examples of that with, as BHP, I think, has traded both two countries. And I think there's a few other examples as well. Now, sometimes the price can diverge, but arbitrages will bring it back into line. So normally they track each other once you allow for exchange rate conversion and so on. So technically it can be done. There may be issues in the listing requirements, may be laxer or tougher in the US versus Australia. The reporting requirements may be laxer or tougher. So obviously the tougher of the two would probably have to prevail here, and maybe ASIC would insist on that anyway. But I think it can be done, and it does have the advantage of improving the depth of the investor base for the company, which is probably why they want to consider it rather than just having an Australian base. The problem, you're right in pointing out there has been a downtrend in IPOs. That does raise long-term problems for the Australian share market and does also, I guess, force the investors, super funds and others, increasingly to invest more globally in global exchanges, which has been happening over many years anyway. But there's sometimes an argument that the Australian shareholders are less patient than foreign shareholders.
Oh, really?
It's some issues, and you could argue that US investors might be more patient in some ways. It'd be hard to back this one up, but it sort of goes back to that point we were making earlier, and I made about the venture capital business being a lot stronger in the US and investors being more prepared to wait longer term than they are in Australia. And that's why you often see Australia's good in inventions. We're good at inventing things, but the research side, but the development aspect where you bring that invention to market or innovating is not so good in Australia. You often got to go to the US to do that because you can get access to more patient capital than you can in Australia. And so there could be some element of that in this as well, that the company may hope that having NASDAQ shareholders on their register would potentially lead to more patience in terms of whatever they're doing on a long-term basis, potentially.
Yeah, true. So this is a way, the way I'm viewing this is Rox probably came and said, we're going to list on NASDAQ. And then the ASX was like, no.
Please don't.
It probably did. Yeah, it probably did.
We'll offer you this, that, and let's make it a dual listing. But do you think this is a way for the ASX to potentially attract more international companies?
That's tough. I don't really see the easy answer to that.
Yeah. Possibly. We'll leave it at possibly.
It's difficult. I mean, Australia, a lot of these issues were raised at the productivity
they were.
reform roundtable, and they're all tangled up in that we need to become better in, we've got to list superannuation money, but not enough of it's tied up in innovations. See, the research happens, but we're not so good at the innovation side. And then you need the patient capital for that. And whatever Australia can do on that front, I think is critically important here. But ultimately, if we were having more innovative companies come through in Australia rather than the idea is generated here, then they have to go to America. If that were the case, then you'd have more companies which would then list on the share market and would give you a bigger pool of IPOs coming through. Yeah. So the lack of innovation here is partly behind the lack of IPOs. There's a bunch of other issues as well, but anything we can do to improve innovation and the incentive structure to make it easier for Australian companies to innovate, then and start up and bring something to market, I think that will help the ASX ultimately.
Yeah, definitely. Well, I think that's all we have time for today. Lots of topics covered.
Yeah, heaps.
Yeah. Thank you.
A depressing morning for me, I must say, because I learned late last night that my hero, Robert Redford, had passed away at the age of 89.
Very sad news.
That is true.
Yeah.
Yeah. I was trying to think back. I don't remember the last time I've seen Robert Redford in anything.
He did have a few. There was a few later career ones, but I mean, once he's 89, I think.
Yeah,
so,
89 years old.
But there was
I
one.
think his last feature film was Sissy. I'm a fan, so I've actually got the DVDs. I love DVDs. His last feature film was it 86, 87 or something with Sissy Spacek, and it was called Old Man.
The Old Man and the Gun. Yeah.
Old Man and the Gun.
No. It was when he was like 86. It was a couple of years ago, but The Old Man and the Gun, where he plays a bank robber. It's a David Lowery movie. Yeah. Which is it's quite good. I really quite enjoyed it.
There was another one where he's a single sailor. He's sailing around the world.
Yeah, he's by himself in a boat.
That was probably more than 10 years ago. But my son argues that Old Man and the Gun was not his last film, because that's when he said he's retiring. His last film was actually Endgame, Avengers Endgame, because you may recall that Robert Redford.
Yeah, he's one of the Security Council kind of people on a screen.
God. Did not know that. Yeah.
He's in Winter Soldier, which I saw with my son.
Yes.
It was when he was like 13. My son was 13 or something or other, and we saw Winter Soldier, and I went along because Robert Redford was in it. I think he might have come along with me to see that one about Robert Redford in the boat sailing around the world. Yeah. But when the boat gets hit by the boat bangs into a container or something, so the boat starts sinking, and then it's about his way of surviving. But my son argues that because Robert Redford had a bit part in Avengers Endgame, then that came out, I think, after Old Man and the Gun. That he says, that was actually his last film.
Yeah.
Well, I think your son's right. Your son's right.
It technically counts, but it's like at most a cameo.
Yeah,
but it does technically count.
But speaking of, you mentioned Anthony Hopkins is about the same age.
He might be older.
He's still acting.
Yeah.
Which
I mean, so The Old Man and the Gun was 2018. So that's like 7 years without like a proper feature role. And so Anthony Hopkins, he's been fairly active. It wasn't a large movie or anything when it came out, but it was really good.
One last question, Shane. Have you seen or do you know of Only Fools and Horses?
Only what?
Only Fools and Horses, the TV show, the UK TV show.
I haven't heard that one. No.
There we go. See, vindicated. She was having a crack at me for not having ever watched it and not getting a reference she had from it earlier.
Please have a look into it. Only Fools and Horses ran from 81 to, when was it, like 2003?
But only 7 seasons.
It's a comedy show, UK comedy show. Although it says crime on it's definitely it's sort of tangential, but no, it's a comedy.
Watch the heist.
Have a look. Have you started watching the heist?
No, I haven't.
Put this down on write this down as well. So this is I was testing because I thought I'd made a joke yesterday.
Yeah.
Only it turns out that
Sadly,
no one
none
had
of us
ever heard
got
of this show.
Yeah.
And I was wondering why no one was having a laugh along with me.
I thought you were implying Robert Redford was in it or something.
No, he wasn't.
As a quick one,
this is English. Maybe.
As a quick one, if you're a massive Robert Redford fan, what's your favourite Redford movie?
Oh, The Way We Were.
The Way We Were? Okay, interesting.
It's a classic.
Interesting.
I even have a cry at the end, when he splits with the Barbara Streisand character.
Yeah.
And then years later, he meets up and she's at a protest in New York, and I thought that was kind of sad.
Yeah.
It's a brilliant film. When you watch that film, it looks like it was made yesterday.
I think
I've got a brilliant idea. So let's save this for. We'll do a Christmas special where the two of you talk favorite movies.
That sounds good.
Keeps a huge movie buff.
My favorite Redford movie is The Sting.
But
you could argue maybe it's more of a Newman movie than a Redford movie.
Okay, we're going to get into the ins and outs of that during our
3 Days of the
Christmas
Condor
special episode.
3 Days of the Condor.
3 Days of the Condor.
3 Days of the Condor is a close second. Yeah.
Christmas special. I
special.
repeat. Thank you both for joining me today. Thank you to our audience for tuning in. We hope you enjoyed the show. I'm pretty sure that everyone probably possibly enjoyed this last bit more than the rest of it. But thanks Thanks both again, and we'll catch you next week.
The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs and should not be relied upon. Before making any investment, insurance, tax, property, or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.